All right. Good afternoon, everyone. At least afternoon here on the East Coast, where I'm checking in. But Mike is joining us from sunny yet cold Arizona, up in the mountains. We're both from Ohio. I thought the whole point of going to Arizona was to get out. You look nice and bundled up.
Sometimes you got to get out of the heat, Scott. Come up to the mountains.
Well, cool, man. Well, we'll get into it so you can get back inside and warm up. But anyways, the topic for today, as world events have taken off, this is usually when people start looking at their finances. We've been in this industry for me going on 15 years, you over 25 now, I believe, and so we've seen a few ups and downs. I remember when I first came in the industry, I was retired. I didn't retire out of the military, but I got out of the Army in 2008. Literally, I started my terminal leave the day before the Lehman Brothers things collapsed. And I was, starting as a new financial advisor. And I was like, who's Lehman Brothers? Like, I didn't know anything about that world or anything. I had just been recruited in to find clients, as we've learned about the industry. But what comes up during those conversations is, how are my accounts doing? What can I do in these times of volatility? And so our whole concept with the war chest is to go from, hey, if once you're getting out of the military, wherever you're at in that process, we recognize that, one, you're probably not going to die anytime soon. So that's that SPP conversation that we just did a video about on Tuesday. But, also, I'm going to be making pretty good income. And, that might take a while to manifest in a way that is meaningful for you, but it's not going to change the dollars coming in the bank account. It's going to be significant, which means maybe you don't have to take the risks that you were taking in your traditional retirement accounts, because maybe the idea of retirement's changed. Lots changed in the world since you probably started saving in these accounts. So that's the whole idea of the war chest concept. What if we could take those same dollars that otherwise would have gone into an SPP program, for example, or that might exist in a retirement account, such as typically that's thrift savings plan as the largest existing asset of a retiree. Yet you're 45 or 50 years old, not really supposed to touch that money for another 10 years or so. So we got to get some growth on, but we've got volatility, but we're nearing the time where we're going to use the money. So priorities have changed. Is there a way to take some of that uncertainty off the table? And of course, yes, absolutely. That's why we use the save money strategy as our primary philosophy at US Vet Wealth. And so we're going to get into that, introduce that a little bit. And remember, our theme is always that, hey, these are great things that you get for being in the military, being a military retiree. They're not always beneficial at all times for everyone. They're features that you can turn on and off. There comes a time when you're getting out of the military that you have an option to roll over your TSP if you want. And so thinking about the performances, first, where does this typically come up on the timeline? It usually doesn't come up till you're actually retiring. When is that day? Age 65, 70? I mean, they keep pushing it back. And what we find is you could save $1 million in your TSP. And if you're following the rule of thumb, way out here, all these years of doing the right things to get to those golden years, and you're only supposed to use 4%. That's the old rule of thumb. Now it's more like 2.9% recommended due to inflation and everything. Either way, you've done all this work to save $1 million, and you can only touch 29 to 40K of it. That's not a great story as well, considering the volatility that happens in the market. Anyways, because this is just my kind of tongue in cheek. If you haven't seen this website, go to usdebtclock.com. I mean, it's kind of a joke in the sense that it's just ridiculous at this point. Way up here in the left is the brand new national debt number that we just hit 33 trillion in September. That was a big deal. It's already gone up $500 billion just in the last couple of weeks. So something
they're projecting, Scott, they're projecting 50 in the next 8 years. $150 trillion. And what that doesn't incorporate is what they call unfunded liabilities.
Oh my God. Yeah.
So what is that? So Social Security, Medicare. So you throw those in there and the number is even more ridiculous. 150, 180, $200 trillion of
Oh,
liabilities.
that's down here. So in the bottom right,
Oh, is it down there?
that's actually on here.
There
So
you go.
that's the cool thing about this website. The whole point of this website and why it's so confusing is to point out, hey, they only tell you about this big, the deficit or the debt number that keeps ticking up. But what about all the unfunded ones? And what about all this other stuff? The defense.
God, I can't see that screen very well. Is the GDP represented on there, the income side of the equation? I don't see it on there. Do you?
I'll have to look at it
Okay.
closer. Yeah, again, I didn't pull it up for us to analyze it intently, but just to kind of prove the point of there's uncertainty and there's more in the world. We're obviously focused on the financial aspects of the uncertainty, but everything impacts the finances, right? It's when we talk about the risks out there or the dangers that we're protected against using the safe money approach is, okay, if we can take risk off the table, do we want to do that? And that's why we use insurances. That's the point of insurance. Insurance companies mitigate against risk. How do they do that? Well, they got to make sure you're a good fit for them. And they do a contract to deal with you. And there's stipulations of that contract that mitigate the risks because you're pooled in with a bunch of other people. So now you're kind of, on the same side of the table of the insurance company, as opposed to just putting your money with somebody in Wall Street. So that's the financial risks that we're trying to take off, the uncertainty of the markets. And we'll talk about that specifically today. But I just want to touch briefly on, when I talk about military retirement risk, that has a lot to, what do I want to do? How much leeway am I giving myself to really figure out where I want to live, what kind of income I want to earn, and what do I want to do with my time and for how long? And unfortunately, what we see is because of just a lot of the financial uncertainty that we don't think needs to exist. That's the point of the war chest. We can help you gain some clarity of your military pay and benefits so that you don't feel like you're just rushing into a whole new career for another 20 years that you didn't give yourself a chance to say, hey, is this really what I want to do? Taking into account, when we say society risk, I mean, things like, as we talked about, unfunded liabilities, people are living longer, taxes are going to go up again, of course, and then your health. We think you're healthier than most. So if you're not getting rewarded for your health, that's a risk. You're getting penalized in a way if you're paying for costs that you don't need to. So we just bring all that into the table when we're having these conversations, because ultimately we think that you can go from the typical approach of thinking, hey, you just need to do more investing, more insurance, wait longer, make more income, versus we think you've already probably got a lot going for you. You just need to maybe reorganize it into, instead of getting more insurance. Yeah, you might need more insurance. That's obvious. What you're really trying to do is get a backup plan. And what we're going to talk about today is securing a second income stream. That was the point of doing the career in the military, to get the retirement pension. So if we can turn your TSP into another guaranteed stream of income, and then you just don't have to worry about it anymore, especially since you got a 10 plus year time frame to wait. That's where when we talk about the performance of the accounts becomes less relevant, because we're focused more on the guaranteed income stream. However, we need to have performance in the market, and when it's not going so well, it can bring a lot of uncertainty. So we'll look through some numbers here in a second, but some other aspects to consider when you're looking at traditional retirement accounts. Yeah, you can get some tax benefits and you can get some market growth, but if you're in through a savings plan, 401k, or any sort of mutual fund index fund, you can't access it until that particular you're till age 59 and a half without penalty. And there's typically not any downside protection unless you're just in cash, or maybe a very, very low risk account, but you're not going to get a lot of growth in that regard as well. So that's why we some of the other aspects of the war chest, we can do that, and we can do some of the insurance things, do all the insurance things as well. But we can also mimic a retirement account, right? So, and the way we think about it of is as a pension, rather than having a retirement account, we don't know how. We just got to wait and see how the performance works and see how big the account gets before we can touch it. We're more focused on just saying, all right, if we can guarantee an income stream, then maybe we don't have to worry about all this stuff as much. So I'm going to zoom in on this as much as I can here, since that's a screen. But kind of, Mike, I wanted to set the stage there a little bit to, have you talk about the discussion from the traditional. All right, usually you're talking to an investment advisor, and they're just going to show you different backdated returns and to compare it to something. And of course, we can look at the TSP returns here and compare it to stuff. But then on the insurance side of stuff, index investing is sort of a different definition, or it has a different meaning. So I think we'll get into that next. But I'll pass it over to you, man, and let me know if you want me to bring anything else up, if you want to share your screen.
Cool. Yeah, thanks, Scott. I appreciate that. So this screen obviously just shows the TSP returns since date. I just want to step back for a minute and talk about TSP and why we do it. And most of us, as we're transitioning out, we've done what the government has told us to do and put money in TSP, just like a civilian would in a 401k. I've asked more than one person why, and the answer was that's what we were supposed to do. And that's okay. But then you think about the end game, right? You think about the transition point, and you've done what you're supposed to do, and you've saved and invested in your TSP and your retirement account during your service. And then now when you're thinking about the second stage of your life, what happens post-military service? For most folks, like you mentioned, Scott, a second career, private sector, and working for themselves, entrepreneurship. We'll talk a little bit about that and opportunities there. But we've got this TSP bucket. We've got these funds that saved and spent and saved for 20 plus years. And then the question is, again, the loose objective is income. I want to use it so I have a retirement. Okay, well, what does that mean? I really don't know, but I want to use it to help my retirement. And I said, okay, well, as Scott pointed out, there's a kind of a infamous Wall Street, term of 4% rule, meaning you can withdraw up to 4% of your account, and it should, and I'll use that in air quotes, last the rest of your life. What we don't like about that is, what if you pick the wrong year to retire? That's what's called sequence of returns risk, and it really says taking money out of an account in a down market is really difficult to recover from over the long term. And so, if you were on this, what I've highlighted here is last year. The TSP last year was not a good year anywhere. The stock market was down. Obviously, the TSP was down. And if you would have chosen last year to retire, if you got unlucky, quote unquote, and retired in 2022, your portfolio was down anywhere between 13 and 26% in the year you start taking money out of it. Well, that's disadvantageous. And again, we've got studies that proves that cuts the lifespan of those dollars by a third. And so then you get into your 70s and 80s, and if you use that 4% rule and you do have down market years, you run out of money. And that doesn't sound very appealing after all those years of savings. So what we prefer to do is replace the hope, should, last type of an idea with guarantees and certainty, right? So through the insurance markets, we have annuities. Annuities do exactly what we talked about. They guarantee income for the rest of your life. They also have zero downside. So our clients that were in our products last year didn't lose a dollar versus losing 12 to 23% as some of the TSP funds did last year. So that's meaningful. Not losing on the downside is more impactful than winning big over the long term. We've seen that proven time and time again. The second feature is, again, the goal for those dollars. This year, 5 years from now, 10 years from now, never. We have the option as a annuity holder to tell the insurance company, hey, we want to start getting lifetime income. What is that? That is a paycheck paid to you for as long as you live. no matter what happens, fully guaranteed. So again, that withdrawal rate's somewhere in the 5, 6, 7% range, depending on your age and a number of other factors. So if we're guaranteeing, call it 5, as opposed to hoping for 4% withdrawal rate, that's meaningful. But what's more meaningful is the peace of mind. There's been numerous studies that folks that retire with an annuity have a more fulfilling, happy retirement because of the income certainty. So again, we'd rather replace the hope for and should last, and gosh, I hope it does, to let's just guarantee it. Let's take those dollars, let's protect them from market risk, and let's guarantee an income stream for the rest of your life, again, when you're ready. So that's kind of how we approach it. Just to wrap this TSP page up, not a bad thing. Over the long term, it's done fine. But really the concern is the down years. And again, more specifically, as I mentioned, retiring in a down year. And again, you don't know. You pick a retirement date 3 years out. That's the year 2022. I'm going to take my retirement, start taking down income from my TSP. What do you mean I lost 20%? What do you mean my income's 20% less? What do you mean my money lasts 20% less longer? Why don't we remove that risk? Because that's what we like to do.
Well, cool. So now, typically, how we do this, we're doing indexing. So on both aspects, our offense and defensive, there's still insurance products. So when we're doing indexing, what the insurance companies do, it's actually a different insurance inside of a life insurance policy or inside of an annuity. There's lots of different ways to actually invest the money, and one of the ways the insurance companies do it is to buy insurance on the market or buy insurance on various indexes that they create. So a different level of money management. It's just that they're essentially buying insurance on the market. So that's how they don't have to worry about the downside. And then the cost of the insurance is essentially, how much return on investment you can get. But we have uncapped growth options for both the insurance and the annuities. But for today's purposes, we're focused more on the defense. How do we guaranteed on the annuity side, the lifetime income stream, but also maintain some uncapped growth with the principal protection without any downside?
I think it makes sense, Scott, right now just to take a minute and explain what index means. I mean, most of us have heard it. Most of us kind of get it, but I think it's important to understand what it is. So an index, the most common one folks are familiar with is the S&P 500. What is that? That's the 500 largest stocks that trade on the New York Stock Exchange. It's an index. So you can buy an index fund. Well, the SPY is an ETF, is an exchange traded fund that buys the 500 largest stocks with one investment. And the benefit of that is your money grows based on the global stock market. What we dislike about it is it works both ways. So the S&P 500 is an index. You can buy the market. Market goes up, you make money. Market goes down, you lose money. Insurance companies, however, they take the downside away. So same index, same S&P 500, we're going to get the upside participation to a point. So not all of, but most of, somewhere around 80% or so of what the market does on the upside. But in a tough year, in 2022, when the S&P was down 19%, these products have a zero downside. So the index is simply a picture of a bunch of different investments, stocks, bonds, etc. There's thousands of indexes that monitor the various markets. And with the defensive strategy here, this fixed indexed annuity strategy, once again, we pick one or more of those indexes. That is how our money grows. And again, when the markets have a tougher year, when we have a down year, we have a zero floor. So that's kind of what we lean into the index for.
Awesome. Thanks. Let me see if I got one other slide here. Yeah. So, our objectives essentially here is, why are we doing this versus a traditional retirement account, or as a supplement to or an alternative to, is we get more control by privatizing. We're essentially creating a second pension, and so now you have full ownership of it. You don't have to outsource it as much anymore. And then we've already talked about protecting the principal and then profiting on the upside. Yeah, I don't want to go through the system slide here. Just the idea is, regardless if we're going offense or defense, there's different ways to fund it, to access it, to use it. Ultimately, We're just trying to ensure your future income independence. You know, your military retirement is guaranteed. What else can we guarantee on top of that, given what you already have going for you? So that's the idea there. But Mike, if you want to run through an example illustration, I think that'd be great. Or if you have any other
no, I think that's a good idea.
Okay.
No, I do. Yeah, I've got a couple of things that I think will help bring this home for us, Scott. Let me just pull up this page here I'm looking for.
And if you are joining us, we're on YouTube and LinkedIn. So mostly we're chatting with people over on LinkedIn, but we do have the YouTube channel. We've got tons of videos up there on all of our various topics, and we're gonna be doing a lot of these live. So if you haven't, make sure you subscribe, you know, hit like and comment on and all that stuff, because you know that helps the social medias get the video in front of the people who it would help the most. You know, we're not trying to, you know, grow a massive YouTube channel to just get random views or something. No, we're just trying to make it easy for retirees to find us if they're curious on these topics.
Oh, I love it. I love it. All right, I'm going to go ahead and share my screen here, and hopefully we can look at this together. Let's see. Okay, I'm just going to jump over here. Can you see my screen okay, Scott?
Yes, sir.
Perfect. So this is one of the companies we represent. So just touching on that briefly, our firm is an independent insurance brokerage. We represent every carrier of substance in the industry. Over 70 companies, hundreds of products. And so this is one product from one carrier. Specifically today, we're talking about the defensive side. We're talking about that guaranteed lifetime income. We're talking about conversion of all those years of scripting and saving in our TSP to turn that into real money for retirement. And we talked a little bit ago about indexes, and I mentioned the S&P 500 is an index, and that is one option. As I also mentioned, there are thousands of indexes. They're created every day, and I'm going to share just a couple of them that we use inside of this the fixed index annuity. The company is called Athene. It is one of the largest annuity company out there. And so this is one of the indexes available in their contract. This index is called the Innovative Balanced Index. So what we like about this is it's not one stock, one company. It's not just the S&P. It's globally diversified, multi-asset. So several different assets, sectors like stocks, bonds, commodities, etc. This index is managed by UBS, the United Bank of Switzerland, the Swiss bank. And this is an index that is exclusive to Athene. And I could share this. I'm not going to read all this stuff. I certainly can share this with everyone. But the big picture is these are diversified again. Lots of different assets, as it reads here, bonds, equities, commodities, lots of different assets. The idea is we don't need to hit home runs here. We've done the heavy lifting of saving the money. What we need to do is protect it, guarantee it, but we also need growth. And as you'll see, the growth has been good the way these indexes are designed. So just give you an idea what this index has done since the index started tracking in 2007 versus the S&P 500. That's kind of that's the index. Notice the line when the S&P was down right here. This index kind of just dipped a little bit. When the market dips, it dips a little bit, and it tracks the index. But when the markets dip over here, it really held steady with the commodities and bond exposure. So diversified one. This is one index of several. Here's another one. This one's another multi-asset index. They use the IBM Watson artificial intelligence, if you will, to design this one. By the way, ticker symbol. These are, go out on Bloomberg and pull these right up and see exactly what we're looking at here. But here's, again, the information on this index. Same kind of idea versus the S&P, just more steady growth. That's exactly what we're looking for here. This is a third one. Again, steady growth is the objective. This one's done really, really good. This is also an AI-based index. So again, it's using smart beta. It's using artificial intelligence to create a low volatility index that stands the test of time. So these are several of them. We've got 24 indexes available to us in this product, but I'm just going to jump into what actual numbers look like for you guys really quick. So this is one of our clients that we're working on. He's rolling and he's transitioning out of the military after 24 years. And he's got $200,000 in his TSP. And I said, gosh, let's guarantee it. So he's like, yeah, I want to guarantee it. So I'm just going to jump down to what this does and how the product works. So this individual, he's 44 years old. As I mentioned, there's 200,000 in his TSP. And these are the index we've allocated to. So we looked at this one here. This is the Bank of America. This is the UBS we looked at. This is another one we looked at. So these are different index options we're looking at. First thing about this contract, nice bonus. So there's a 36% bonus on the premium going in. That's tremendous. And also what we like about this is no fees whatsoever. And so just getting down to the numbers, this individual, as I mentioned, is younger. He is younger, so he is 44, and he's going to retire at age 60. So he put in $200,000, as we talked about earlier. There's a bonus built into that, so that gets us to 290. This dollars just continue to appreciate based on this assumed interest rating or growth rates. This is, so you know, this is what this contract did in real life over the last 10 years. And that's what it says right here, most recent 10-year period. So this is not speculating, guessing, cherry picking, literally what it's done over the last 10 years. And so this is the growth over that period of time. At age 60, he says, I'm ready to take income. The first year income is $48,000. First year, okay, based on his 200 going in. What we love about this particular contract is anytime we have positive return in this index, the income goes up. So the first year it's 48,000. The index was up 8% that year. The next year the income was up 8%. Went from 48 to 52. That year was a bigger year, 25% return that year. Income goes from 52 to 67. Here's a 4%, so it goes up from 67 to 70. Anytime we have positive growth, the income goes up by the same percentages. Here's a flat year, 0.06. On that year, the income basically goes up by $100, but it doesn't go down and it never goes backwards. So that's one thing. And the other thing is I talk about annual lifetime income. This is a guarantee of income for the rest of your life. So I'm just going to go forward here. Now he's in his 70s. This is the annual draws, 170, 180, $240,000 in his late 70s. And it just continues to grow from there. And you'll see, you know, God willing, this guy lives to his early 90s. He's taken $11 million in income over that period of time. Now, again, that's 50 years, but that's a lot of money. What I like to point out is a couple of things very quickly. You see the zeros over here. There becomes a point in time in the future when the values in this contract are gone. We've exhausted them. What do I mean by gone? Well, remember, we put $200,000 deposit. We've taken $1.7 million out in income. So at that point, there is no more value in the contract. The death benefit is gone if he passes the way the contract expires. I would say it's a good trade, $200,000 to get $1.8 million. But what's really kind of cool, even when these numbers go to zero, this is a guaranteed lifetime income. So you'll see the numbers are zero. This income hasn't stopped. The income continues to grow for the rest of his life. So even when the account values are exhausted, the income continues. It is a guaranteed paycheck for as long as you live. Okay, so that's pretty cool. The last thing is, let's think about it the other way. Let's think about it if, God forbid, he passes away early. Let's say at 72, he gets hit by that proverbial bus. At that point, he's put $200,000 in once again. He's taken just over $1 million in income, so he's already, significantly in the black. But any money inside this annuity that has not been paid out to the annuitant in income is paid as a death benefit to his family. So if he were to die this year, again, he put 200 in, he's taken $1 million out, and there's 648,000 as a death benefit to his family. So again, what I'm trying to point out here is income guaranteed for life. God forbid you pass away early, plane crash, whatever's not been paid out is paid to your family. So those are the things we really like about the annuity. And again, for this individual, remember, it's $200,000 of his TSP money that he worked 20 plus years to save, and now he's ready to turning into a guarantees and enjoy his retirement.
And Mike, and folks ask, well, how do they do that? How can they guarantee an income for life? Well, it's the same as a pension fund, like a state pension fund. There's somebody managing that pension fund, and usually they've outsourced it to BlackRock, and they're charging fees on it. But they've got to create those assets to guarantee lifetime income streams for their clients, a state employee, for example, right? So, usually has to do with like university pension funds or some sort of education.
Even in the private sector, they're pretty much gone these days, but that's the
Right.
idea. The idea that you're mentioning, Scott, is how can the insurance company afford to provide lifetime income? The answer, and you touched on this, they use the law of large numbers. They look at hundreds of thousands of annuitants in pools. That's how they manage their business.
Mhm.
Athene is doing about $80 billion a year in new premium into their annuities. They are the largest player out there, and they manage those dollars for very long-term growth. And so they built into the program on how they built these products. And again, they look at a bunch of folks, and that's how they come up with their numbers.
Yeah, so that way it's pooling assets, for a similar objective, and you can tap into it when you're ready, and they guarantee it, so it's all nice and insured. But well, awesome, Mike. No, I think that was good to for today to show the comparisons of, because essentially TSP C fund is the S&P 500. That's the thing that always comes up when you're comparing returns. So while our war chest, we're not doing this to beat returns. We're not some sort of hedge fund out there that's trying to compare to the stock. I don't follow the stock market on a daily basis because we don't need to. But it obviously comes up and we have to show some level of return. And so you're going to compare it to something. So that's why we want to have this conversation today. So you can see, all right, let's take a look and compare it. Not only can guarantee a downside, we can usually even do better on the upside from not having to make up from losses. We don't talk about that too much. We do talk about average returns, but not real returns. The average, if you lose 10% 1 year, if you go from $1,000, you're down to $900, and then the next year you go up 10%, are you back up to $1,000? No, you're only up to like $990, right? So it'll average out, but it's not real return. What we're doing in the war chest, everything you're getting is real return because we don't have to make up from losses. So that's a big part of the story. We'll touch on more. We touch on it inside the book. So if you haven't yet, you can get it from Amazon and get the hardcover copy, but it's free, available on our website. You can go inside of our portal. Had a great conversation with somebody yesterday who said he went in there, read the book, watched a bunch of videos, and then we jumped on a call, and he's already asking about, hey, how do we learn more about this? And so, anyways, I think he's talking with Mike next week, and so we're just really excited at all the great feedback we're getting from this new program, and a lot of introductions we've had recently. So things are going great. We're growing, and always open to feedback, but would love to have. Oh, I know what I was going to say. The big thing we got going on right now is our new way of working with us is, I was calling it an audit before. It's like Trevor said, no, appraisal. I was like, duh, yeah, of course that's what we're doing. We're taking a look at, regardless of where you're at in your military retirement process. Maybe it's a few years out, or maybe you retired years ago. Have you actually appraised what your time in service got you? Like dollar for dollar standpoint. And it's easy to do. It can help alleviate so many questions you have, especially when it comes to how much insurance do I have? What do I do about survivor benefit plan? Do I need to keep taking these risks in the stock market, whether it's TSP or otherwise? We can show you, and these are all just using the government calculators. I've just put it together into a simple system where we can look at your probabilities of positive outcomes, and beyond that, we do that for you for free. Like no question, no strings attached, because we know every retiree has got these questions. We've done this hundreds of times, and so we just know how to answer it. And we've seen so many different situations that probably what you're going through, we've seen before. We can just give you some perspective on it, so you can just say, "Aha, that's what I need to do." Let's get on. Let's get on to the things that are going to be more useful, because this is just math. We can help translate, some of the emotional, and timing is where we can help you out there. And then obviously, if we see opportunities where you'd be a good fit for working with us and learning about the war chest, you'll probably have watched our videos and read the book in the meantime as well. So we can talk about that stuff if we see an opportunity for that. And that's our business model. We are happy to give away our information, absolutely for free, because we know some of you are going to be a good fit. Since we're working, traditionally or typically we're working with the more senior NCO, senior officers, been in a little bit longer, or retiring at right at 20, but looking for the higher income, post-military jobs, kind of, getting into the networking, position yourself well. You're going to be making $250,000 income pretty soon, once you add that pension up, in which case um, your financial strategy maybe should match your income level, because that's where things get missed out, because we're leaving money on the table if we don't do the appraisal properly, and that just means you're not being rewarded for your health, so you're just not going to get the most bang for the buck. And we think you served for it, you earned it. Let's show you how to do it, how to qualify for it, and it all starts with the appraisal there. So that's how
I'll jump in there just quickly, Scott. So,
yeah, please.
Scott, we lean heavily into the education. And I love that. I love educating folks on options. I love saying that there's no right or wrong, good or bad. There's the government public plan. There is the private sector, private pension war chest strategy. And let's talk about both. And we'll look at your individual situation, just as you said. The great news is, when we go through AB, here's 2 different ways to approach this, and here's 2 different ways to structure this. Folks come to us and they say, hey, thank you for telling me how both guys works. This is more appealing to me. So it's not even like we've got to tell them this is a better way to go. They tell us what they want, because we're doing the right way, and educating and empowering and that early retirement thing. One of our clients had mentioned, gosh, I got out at 47. I want to retire by I'm 57. And I want 10 years and done in my private sector job, and let's build a strategy to do that, and that's what we're doing. So love helping folks, love educating and telling the story, and the fact that this is all safe money stuff that, we know that, we're protecting families every day, and that's what we love to do.
Yeah, and we're able to complement, and that's why we say we're not trying to be your financial advisor. You either are your own financial advisor or you have one. Where we are is private consultants that Mike's works with other financial professionals such as us, bringing expertise, and so that's what we can bring to the table: access to the particular strategies, and knowledge, and all the paperwork and all that kind of stuff, right? But you make your own decisions, right? Or work with your advisors to make your decisions. Bring us in as needed is the approach, because we're gonna, even other financial professionals who do work in insurance, they typically don't know about the products we use, or don't have access to the versions of the products that we do. And that's just through Mike's relationship with Ash Brokerage, which you see here on this slide. This is just to represent, hey, what is this military retirement blueprint, online portal? It's growing. It's a growing platform. Right now, it's a place for us to host our education. We want to turn it into a networking platform. We're working closely with the Blue Water Advisors and Mike Wallace. And the great thing they're doing over there, which is getting people jobs, which is income, right? So if you're doing what he says, you're going to be making good money soon, and we want to help you protect it, right? So we think the easy way to do that is to start with the appraisal. Some of the other programs we've got coming out will be fun to talk with you about. So we can get on a call and and chat about any other questions you have in the meantime. But cool, man. I think that's all I got for now.
Good. Well, thanks for having me once again. Always good to be here, Scott.
Absolutely. No, absolutely, Mike. And have fun out there in Arizona. You guys going shooting again?
No, working today, unfortunately, but we've got some friends for the weekend, so we'll probably get the guns out and do a little target practice. Yeah, for sure.
Great. No, it's funny. I went out to where Mike's at a retreat in Arizona, and they did shooting, and I don't know. I was in the Army, and it just, for whatever reason, I'm like, I don't know. It just seems like I'm just not into it. So I'm glad everybody else enjoyed it. I think I'm gonna wait until
Well, those
we
are
need
fun events,
to
Scott. I appreciate
yeah.
you bringing that up. I mean, we bring in mostly financial advisors from around the country. We come up here to the Arizona pines at 7,000 feet of elevation, and they don't even think of Arizona when they think of, the cool weather and the pine trees. And so we come up here. We got some side by sides. We go out. We do some shooting. We have some dinners, and we do some meetings. And
Yeah.
what we found is, our mantra is leave your suits at home, bring your boots because we're going to be up in the mountains. And let's just break down all the barriers. We've got advisors, financial advisors, CPAs, insurance agents, estate planning attorneys, everyone together, learning together, working together, collaborating together. It's just it's been a tremendous whirlwind for us in our business.
Yeah, and so I mean that's the cool thing about being in this. If you ever are considering about a career in financial services, there's all sorts of different licenses and stuff and ways to tap in. But if you are in the industry already or considering it, and let's say you did work through us in some capacity, then cool, you automatically have access to Mike and what they got going on up there in the mountains, and maybe you'd be going up there one day, or maybe we bring a team out there.
Yeah.
I mean, that's where I learned about these strategies. It was like, holy cow, this is not that complicated financial stuff. Why doesn't everybody know about this? Well, it only works when you've got enough money for it. So it's what wealthy and high income earners do, and that's what military retirees are going to be most likely. And so, well, why don't we show them that advantage that's just sitting right there?
Well, yeah, and on that front, I love sharing the stories, Scott, as you know, that we've helped a number of retiring military professionals with their financial matters and their insurances and their guaranteed incomes, and they've gone through the process personally, and then after going through that process, thinking about that second career, do they really want to go work for L3 or Booz Allen Hamilton, or would they really think about a career in entrepreneurial where they work for themselves? And several of these guys have come back and said, "Hey, we love what you guys done to help us with our personal matters. We're getting licensed. We want to help other veterans." And so that is, I think that's the biggest testament to what we do and the fact that we are helping people. And so, yeah, I think that's a good shout out. I mean, anyone that's interested in learning about how we do what we do and how we help people, veterans or otherwise, protect their families, protect their dollars. We'd love to have those conversations.
Yeah, because I mean, essentially, that's my first book was about veteran wealth secrets. Is I was just laying out how the whole industry works, and yeah, probably I was a little disgruntled because I was so shocked. I was like, this stuff doesn't need to be all secret. It'd be more useful for everybody if everybody wasn't trying to poach clients from each other or say, hey, we're better than this or that. We don't have an opinion. We're just like, all right, do you have a problem that needs solved? Like, I mean, sure, I got opinions, but if you may be a better fit for, regardless of where you're at on this map, or even if you're working with any of these institutions, what we do is explain it. What's the difference? When do you use this one? How do we work with them? And so I'll help you decipher what you may have going on already, right? That's what's more useful for us. So that way, we'll all know if we're a good fit to work with us on our strategies. That'll be very clear quickly. As long as you understand what you have and don't. Unfortunately, a lot of folks don't because they got started years ago and got deployed a lot, and it just hasn't come up yet. So now's the time. Let's do the appraisal, get you caught up with your finances, and then help you. If you want to, need to go back to your existing professional, that's fine too, because we know, hey, maybe a couple years down the road, it would make sense to work with us. And so that's our business model. So happy to work with you in that capacity. Hit us up on LinkedIn, shoot me an email, go to our website, usvetwealth.com, to download our stuff. And that is all for now. We'll see you guys next week. Thanks, Mike.
Thank you.